Good morning, traders. Good morning. Good morning. Good morning, traders. Good morning. Good morning. Good morning. Good afternoon to some. I guess it depends on where you are in the world. It might even be nighttime for you. We've got traders piping in from all over the world, so I'm sure you're experiencing today from different times. But wherever you are, whatever time it is, welcome. Welcome to another trading poker card study session. Nighttime in Philippines. That's right. Yeah. All right. I'm very glad that you're all here. I'm very glad that you are all here. Guys, I want to remind you of something. I know you're aware of this, but it's still worth repeating this every now and then. Traders, look, the cards that you hold in your hands or that you have in your possession, they're not just a toy. They're not just an ornament. They are a very powerful way to, I guess, burn some of my trading concepts and tactics, to burn them on your mind, as it were. The frequent and constant repetitive review of those cards will do something internally over time. They will help you automatically, almost unconsciously, begin to pick up opportunities in the market, pick up things that are noteworthy in the markets. If you take the casual perusal of the cards even further, and you dedicate some time, for instance, to 2 or 3 of the cards. I'm going to dedicate time to practicing identifying these 3 cards. If you do things like that, you can take what the magic that the cards will, you'll take the magic to a different level, traders. As an example, you can take the card like the Bull 180 card, all right? And you can go into the markets or open up a charting software and just practice finding that card. Practice finding that pattern in all different time frames. The time frame really doesn't matter. But the magic that's going to happen is potentially life-changing for you. And so, in addition to that, your membership in this club involves us meeting once a month to touch base, to bring a live element to the cards, to deepen, I think, what the cards can do by themselves with a personal element to your membership, right? That there's nothing that can ever truly replace us being live together, albeit in an electronic form, but still nothing can truly replace that. And the reason why I go over this before we delve into some material today is because While I should see this group growing every month to all-time new high attendance, the reality is that I don't. That I actually see the attendees get a little bit less and less every single month. Now, this goes hand in hand with the reality in life that trading or playing the markets professionally is no different from any other activity, traders, that the 80-20 rule more or less applies. That no matter what the endeavor, no matter what the pursuit, 80% of the people will tend to basically go away, quit, leave, not finish, and 20% will. So we're going to always have that 80-20 rule for the most part, but I just don't, I want you to try to make a, what should I say? I want you to try to make a promise to yourself that you're not going to be the 80%. That's not how you do things. That you do not operate the way the vast majority of people operate. That you do not leave and quit and move from one thing to the other. That you are the 20%. You know, and of course your attendance here suggests that you are, right? And I know that life intervenes and sometimes we can't attend when we really want to, but that's not what I'm talking about. I'm talking about the people. There's 80% of the people who have taken the step to be a part of what we do here with the cards, that basically have those cards in a drawer somewhere. They no longer utilize them. They no longer look at them. They no longer review them, and they no longer attend these sessions, which are their right for life. It's just another thing that they've bought and thrown in a drawer somewhere to collect dust. Don't let that be you. Do you understand what I'm saying, traders? Don't let that be you. All right? All right. Awesome. Okay. Guys, today, what I want to do, let me get some charts up here, if I can. I want to talk to you about something that's actually not specifically in your deck of cards, but you can use what's in your deck of cards with the concept that I'm going to share with you today. So in a sense, this is like a bonus. I'm going to talk about a concept that is not a part of the deck. I'm going to talk about a concept today that is valuable. Give me a second here. Let me get some charts up here. Talk about a concept that's valuable, but is not represented by one of your cards. All right. And so, as a matter of fact, let me just try, guys, I'm going to eliminate that just for a second here. Let me try to make this bigger for us. Let's see if I can make this bigger for us here. Bigger and wider. Give me a minute here. All right. Let's see if that works. Okay, good. So this concept that I'm going to share with you today is not represented by any card in your deck. So in a sense, it's a big bonus. But we're going to use some of the things that are represented in our deck through this concept. Now, I want you to note that I have a stock here. It's ARK. It's ARK ETF. It doesn't really matter. All right. The time frame that I'm showing you is a daily, but time frame really doesn't matter. But we're going to use the daily time frame to teach you this concept. All right. So every bar represents one full day of trading, and I want you to note that I have two moving averages on the chart. They are the 20-period moving average. And do that with a different color there. There's a 20-period moving average. That happens to be the red one. Okay. And then there is the 50-period moving average. Okay. So two moving averages. Now, guys, if you can't see the full chart, you have to, I forget where it is on your end because I have a different module here, but there's an option to click, I think, above you, above the image to fit the whole image, okay? It's in the upper left-hand corner, top left-hand corner, okay? For those of you who are not familiar with this. All right, so we have the 20-period moving average. These are simple moving averages, and the 50-period moving average. And I'm going to teach you how to use these two moving averages as a buddy system, right? To find very interesting buy opportunities, all right? Very interesting sell opportunities. And also, just as important, we're going to use this buddy system to know when things have switched and changed in our underlying stock or play or whatever it is that you're playing. Now, I'll remind you that every concept that I teach you is applicable across all markets. So it doesn't matter what market you trade. And it is applicable universally across all time frames. It doesn't matter what time frame you trade. Whether you're a day trader and you use the 2-minute time frame, 2-minute chart, whether you're a swing trader and you use the daily chart, it doesn't matter. Everything I teach you is applicable across the board. All time frames, all markets, right? The truth is universal. And these are concepts that are deeply rooted in the truth. Now, I want you to notice that as we look at recent history with ARK, we can see that these two moving averages have historically served as a very interesting area or zone of support. So I want you to take note of the zone between the two moving averages. All right. And what you'll note is that these two moving averages, when a stock starts trending, they start to serve as a very critical area of support. So when a stock, you need the stock to start trending, but once a stock starts trending, the 20 and the 50-period moving average price zone becomes a very critical area of support. Now, what you'll also find is that there are times when your item will drop in the zone and come out of the zone. Drop in the zone, come out of the zone. Drop in the zone, come out of the zone. Now, you can see that there are times where there's a brief overshoot of the zone, but a quick snap back above the zone. That's fine. And this is one thing I want to talk to you about. These moving averages are more like zones themselves. They are not the skinny lines that the chart would have you believe. So each line is actually a zone, if you will. So there's the 50-period moving average zone. And here is the 20-period moving average zone. So it's important to understand that it's not a skinny line. These items are areas, all right, in and of themselves. So we've got zones that are creating the major zone. We've got the 20-period moving average zone, and we've got the 50-period moving average zone. And these two zones have a zone running through them. All right. So it is only as long as we don't severely break through the total zone period, we're okay. All right. So you might overshoot the skinny line a little bit, but as long as you don't severely break through the zone, we're okay until we're here. Now that is the severe breakthrough the 20-50 period moving average zone. This is your first sign that things have changed. Do you understand this so far, guys? 20-period moving average, 50-period moving average. Each of those items is a zone with a zone running through them. And all right, good. Now, the severe breaking of the zone means that we've completely changed course. This is no longer the same stop. This is no longer the same trend. That things have broken. All right, things have broken. Now, before going broken, I want to talk to you about how once we know the importance of the zone, we're going to look for opportunities that are off the top of the zone, you see, or in the zone. A lot of times you won't get in the zone. See, this is in the zone. So we don't get in the zone. So a lot of times we don't get in the zone. This is in the zone, but the opportunity comes on top of the zone. Okay, so sometimes we get in the zone, but sometimes we bounce off the top of the zone. So these are going to be our key areas that we focus on. We want to find an opportunity off the top of the zone or in the zone. If it drops in the zone, we're looking for the opportunity out of the zone. If we drop back to the top of the zone, we're looking for the opportunity to ricochet off the top of the zone. Now, what specifically are we going to look for? We're going to look for, this is where your cards come in. We're going to look for any of the main events that are represented by, I would say, represented by 3 dominant cards. So the cards that you're going to specifically look for are the elephant bar card, the tail bar card, okay? And you're going to look for the Bull 180 card, tail or cola, right? Spanish. So you've got 1, 2, 3. And to keep this really simple, all you really need is a color change. All you really need, give me a second, guys. Give me a second. Give me a minute. All right, guys, sorry about that. I had to break away for a moment. So I want you to focus on these three events coming off of these two areas, or simply, guys, simply, look, you're looking primarily for a color change. What does that mean? Look, anytime a red bar is taken out by a green bar, so we're taking out the high of a red bar off our two zones, okay? So the green bar is superseding the high of a red bar to the left of it. So if we take a look very carefully, look at this. We see right off of our zone, we get to our zone. Now we're simply waiting for a green bar to take out the high of a red bar right there. Boom, right off of our zone. Now we come back, let me do this with a different color. We come back to our zone. Boom. Now simply wait. When's the next time, bar by bar, that a green bar takes out the high of a red bar? Right here. Boom. And it can be as simple as green takes out red in my area. Green takes out red in my area. Green takes out red in my area. See this? Green takes out red in my area. Okay? Green takes out red in my area. Okay? We overshoot a little bit, but remember the 50 is more of a zone. Okay? So you can overshoot very much like you can lean on the ropes and the ropes bend, but don't necessarily break. This is way more than a bending of the ropes. This is a break of the rope. That's different. This is more of a bending of the rope and a quick snap back. So when does a green bar trade above the high of a red bar? Right there. Okay? Right there. Right there. Right there. All right? We can have this happen in the zone or off the top. In the zone or off the top. All right? Does this make sense so far? Green take out red off the top of the zone. Green take out red in the zone. All right. Let's take a look at something else. Let's take a look at, I have something fun for you. Let's take a look at Bitcoin. All right. Now, take a look at Bitcoin. We have the same 20-period moving average. We've got the same 50-period moving average. We see that over history, over its recent history, it has accurately been bouncing off the top of the zone, boing, or it has come into the zone and out of the zone. So either bounced off the top, or in, and we find ourselves right now in the zone. So based on my simple approach of we're going to look for a color change off the top of the zone, or if it gets in the zone, we're going to look for a color change. What will we be looking for next? Just a few of you let me know. What are we looking for next? It may not happen, but what are we going to look for? We're looking for a green bar. That's right. To take out the high of a red bar right out of this zone. Now, it's possible that we don't get that. It's possible that we continue to get a break. All right, that's possible. This is what we don't have to know the future. We just have to play the now. So if a now develops like this, boom, there's our play with the idea of it coming out of the zone. Okay? Now, if we go back in the past, we had that here. Green bar takes out the high of the red bar right out of the zone. Boom. Okay? Green takes out red right off the top of the zone. And we repeat this until we get a reversal, until we get a breakdown, until the bottom of our zone, the bottom 50, is severely broken. So if this were to be severely broken, then we know that this part would suggest that the stock has damaged its flow, damaged its trend, damaged its momentum to the upside, and would need some time to repair. All right? Okay. Do we take out the body or the tail? I mean, in the grand scheme of things, it really doesn't matter. I typically go by the body. All right. So if I blow this up a little bit, I'm going by green taking out red there. See? Boom. If there was a little tiny tail on it, you can include the tail. If the tail is a little more than tiny, then I'm going to really more go for the body and not the tail. That was the question. It's the body that means the most, okay? It's the body that means the most. How do we know that the 50-period moving average zone has been broken? This is I'm going to use this. I always do this. I'm going to use this question. I don't want to offend the questioner. All right, but I'm going to use the question to drill home a point. This is the adult mind at work. All right. And this is largely why children, my trading kids, I have a trading kids program, right? I have over 300 kids that are between the ages of 10 and 15, and they out-trade their parents, virtually all of them. And the reason, one of the main reasons is that children don't overcomplicate things the way adults do. So an adult question will be, what percentage? That's an adult question. Whereas that a kid's going to just say, okay, if the stock drops down here, it broke. They're not going to ask, well, what percentage? How do I actually know it really broke? Can you give me a number? Is there a specific formula? This is all overcomplicating things. All right. The bottom line is that I want you to visually, this is not a break. That could be a bend, but down here, that's a break, right? It's got to be a severe break because this is a zone. So it's got to be clear that this is way outside of the zone, all right? There's no formula, there's no number, just it's clear as day that this is no longer operating off the 20 and 50 period moving average zone. It's as clear as day to me, all right? So now, let's take a look at BABA. Now, I want to talk about breaks. Here we go. Let me just do this, guys. Give me a second. I'm going to take the chart off just for a second. That's just me. I'm going to just make this bigger for us. I'm going to make the chart bigger for us. I need to see more data. All right. Boom. Okay. Now, here we have the zone. We've got the 20 period moving average. We got the 50 period moving average. So we've got our zone. We can see that we have experienced color changes out of the zone. We've experienced not color changes here, but this is one of your cards here, tail bars. There's a tail bar card, right? Right in the zone, okay? We've experienced color changes right off the top of the zone, okay? We come out of the zone, all right? Here, you can clearly see that while this may not have been a clean break, this definitely is. That this piece of data is definitely outside of the zone that was happening. Now, in fact, at least for a period of time, we had the opposite zone in play. All right, but this is a clear example of breaking the zone, breaking it hard enough to be clear. It's clear that this is way outside of the zone. Okay, the screen has a duplicate. Screen's not clean. Okay, let me see something here. Let's see if we can bring it back here. Let me know if this cleans it up. I'm just going to rebroadcast it here. Is the screen too big? Is that good? Okay, better. Okay. All right, so once again, we've got tail bars. All right, this is your tail bar card coming out of the zone. We've got color changes coming off the top of the zone. You've got some color changes here coming from within the zone. And this is a clear break out of the zone. All right. The break out of the zone will tend to have a period. It's a total trend change, right? So you will tend to, this is the former high. The stock will tend to bounce back up, but nowhere near the former high, and move to a new low. Okay, that's the complete reversal of this trend. So a reversal of a trend usually happens like this, guys. Let me show you. You break the trend. There's the break right there, right? You rally back, and then a new low. And that's usually exactly how trends totally change. Up, break, that elongated break right there is what does the trend in. Now the next bounce does not come anywhere near the former peak, and the next drop breaks the low. And this is what traditional chartists would call your head and shoulders: left shoulder, head, right shoulder. And it looks like head and shoulders. Boom. But you can see it here in Alibaba. Break, doesn't come anywhere near the peak, break to a new low. Left shoulder, head, right shoulder, done. Trend completely changed. All right. So we can see a clear example of BABA breaking the zone. We can go to cost and see the same thing as well. Give me a second here. Go to something like cost. So here's an example of not breaking the zone. You're just bending, leaning on the fence or leaning on the ropes a bit, but the snapback, green taking out red, or here, tail bar coming out of the zone, green taking red out right in the zone. But here you have, this would be a little leaning, but down here you have severely broken the zone. That's not leaning against the fence anymore. That's not leaning against the ropes. This is leaning against the ropes. Lean snapback. All right. This is potentially leaning, but it fails and snaps the fence or breaks the ropes. So now rally comes nowhere near the former high and breaks the low. And there's that total turn again, right? Crack. Total turn again. Crack. Shorter rally. Boom. New low. It's over. Looking to the right now, you have the zone in reverse. So you've got the 20-period moving average. You've got the 50-period moving average. And you're getting opportunities the other way now. Getting opportunities the other way now. Red takes out green. right off the top of the zone. Red takes out green right off the top of the zone. Right? Okay. Now, Mauricia said, why do humans behave like that? I'm not quite sure what you mean, but yes, we are looking at human behavior at work. And this is why repetitive cycles or patterns, this is why certain patterns and cycles are repetitive, because we are competitive beings. We're not looking at anything other than human activity. The stock doesn't have a life of its own. It's made up of the collective decisions of human beings, basically. So we're charting human behavior, and human behavior is repetitive. And what's the key drivers of human behavior? Well, the two dominant forces are fear and greed. All right. And so all you're really seeing is how greed eventually gets reverted back to fear. You know, your greed state, and here's your fear state. And the typical way it happens is this crack scares everyone. That one right there scares everyone. Now imagine if you bought here, others bought there, some people bought there, some people bought. Hello, 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 hello. Am I back? I'm good now? Okay. I lost my connection for a moment. Okay. Let me get the charts back up here. The charts are gone. Let me see here. Okay, let me get the charts back up if I can. I hope I can here. Give me a second. It's trying. Yeah, welcome to the Lameno. Let me see here. Give me a second here. Guys, stay put just for a moment. I'm gonna try to reboot and come right back. Just stay put. Don't go anywhere. All right, traders, I'm back here. Let's see if this is going to help me here. All right. Okay. Yeah, I do know that sometimes the big screen sharing affect the does affect my connection at sometimes. Okay, so what I was explaining was I want you to imagine that some people bought the stock here, some people bought the stock here, some people bought the stock here. These people, when this sharp drop happens, these people are now scared that they have made a wrong decision. Fear starts to creep in that they've lost. These people also get scared because while they did have profits at higher prices, this drop has brought them to break even or even to be slightly negative. So you get anyone from this point upward, you've turned from being good to now fearing. These people below are also starting to fear too because a big portion of their profits have disappeared. They might still be profitable, but now they're fearful that maybe they're going to lose all of their profits. So a crack like this turns greed, which is here, to fear. This bounce gives some of these an opportunity to get a good portion of their profits back. These people are not profitable, but they decide to sell because they have narrowed their losses. So the next rally typically will bring in, after a crack, the next rally will bring in sellers in a large amount, because these people get a portion of their loss back. These people get their all of their loss back. These people who lost all of their profits got a portion of their profits back, and they're not going to allow it to drop anymore. So this is all human behavior after this that causes this next move. So here in this scenario, you have the severe crack, the rally, and then it's over. The amount of selling that comes in on the bounce after the scary drop is what kicks off the fear-based trend afterwards. So it is that initial crack of the 20-50 period moving average zone that's your key. A very strong, powerful crack. Let's take a look at something interesting here. Let's take a look at copper. Now, guys, I monitor copper and things of this nature, even though I don't trade copper, but I do monitor them just for overall macroeconomic stuff. So while our officials continue to tell us that there is no inflation to speak of, when you see copper doing this, you know that someone's lying, right? You can't have a meteoric rise in things like copper, which is used in everything in the world. And you can't have that and say that there's no inflation, right? It's impossible. Like the cost of your most valuable, not valuable, your most used item in the world has more than doubled, but there's no inflation. That's dumb. That's just stupid. Like, who are you talking to? All right, but anyway, so I do track these things, but you can see that you have this very powerful 20, 40 period moving average zone thing. Now, it's possible, like copper did, to temporarily break its zone or interrupt its zone and go flat. So this period here is an interrupt. So you've got sort of like, here's part 2, here was part 1, and it took a rest. Guys, am I back? I lost you again, right? I'm back. Okay. Where's the last thing you heard? What's the last thing you heard? Let me see if I can make this smaller. Okay. Let me just make the screen smaller and see if that helps here. All right. So we did crack the 50 period moving average zone here. This is a pretty serious crack. But remember when I told you, when you crack, the key is this next move up. If this next move up is shallow, then we're in trouble. If it comes pretty much all the way back, it's a false crack. You see? So this crack comes all the way back, meaning this was a false crack. You can have false cracks. And so now it resumes the channel. See, this is not a severe enough crack. This is a leaning against the ropes again. Green takes out red right there. Boom. Okay. So that's an interesting thing to keep in mind as well. If your crack comes all the way back to the beginning, this is a false crack. Does that make sense? A few of you let me know. Let's spot those false ones. Okay. If that rally after the crack does not come all the way, here's the origin of the crack. If it falls short, boom, you're in trouble. Like this whole thing is in trouble right now. Okay. Now we are finding that the overall market has a lot of things have cracked, right? We look at Apple. It has cracked the 20-50 zone. You see, that zone is cracked. So what's our key? What are we going to monitor with Apple next? How it rallies. The rally, if it falls short, all right, and doesn't come all the way back, we're in trouble. We are in trouble. So this is an extraordinarily powerful, simple, but very powerful concept that can give you a lot of things, traders. It can give you amazing buy-in opportunities. Look at the buy-in off of Apple here, out of the zone. Green takes out red. Boom. You know, you got your buys off the top of the zone. But it can also, in addition to giving you some amazing buy opportunities, either in the zone or off the top of the zone, just being a tool to help you understand what potentially can come next after a crack is priceless. To know that now the odds of the next rally failing are very high. That's very high. There are going to be people who get suckered into Apple's next move up. They're going to be suckered into it. Only to what's likely to occur is that because of the crack. And now you know that. Which means that the opportunity here is potentially priceless. What's the opportunity here? After a rally, a strong color reversal, just the opposite. All right? A red taking out green, right? And you can look at we've got another ARK ETF it's close here, guys. Like this is not truly big enough for a crack. This either has to do that, but if it keeps going, it's going to be a crack. And once that's done, then we have to be skeptical of the next move up, right? But we need that in order to go to that scenario. So a lot of people are asking me, Oliver, what's your view on the markets? I don't know if you guys remember, I made a post that on December 31st, that within 45 days, I see the market having major problems, major trouble, right? So do you guys remember that? You remember that that warning on the 31st of January? Anybody remember that? Okay. So we're starting to see the deterioration, okay, in certain things. Now, again, the very next moves up are going to be key for us. Going to be very, very key for us. Right? If those moves don't go all the way back to the top, we've begun the other way. We've moved from this, right? So this is where we are right now with a lot of things. We have to monitor the next move up. And if it fails to come all the way back, which I believe is going to be the case, then that starts right there. And that changes the whole game, you see? Do I think Bitcoin's going to go up even if the market goes down? I think that over short periods of time, there's some correlation. But if you go beyond the short term, the correlation is lost. So, for instance, an initial knee-jerk reaction will typically happen. So if the market has a huge drop to the downside, right, a bigger, like it just boom, that knee-jerk reaction can affect things like Bitcoin, which don't really have a true correlation. Short term, but what will tend to happen with a little bit more time is that this gets corrected and moves right back because there really is no correlation. All right. And that's just an initial human behavior. But but there's no correlation between what the market does over time and what Bitcoin does. All right. Any other questions, guys, regarding this concept? It's simple, but it's powerful. And it works in both the up for fashion, guys. It works with the up. It works on the buy side. It works perfectly on the sell side. The only period that's difficult is sideways choppy. So you're always going to have to find a stock that is already within its trend. All right. That way or that way, downward, it works perfectly as well. Sideways, you're going to have to wait for one side to develop or the other out of sideways in order to use it, either up or down. But it's difficult in sideways choppy. So you can't use this concept in sideways choppiness. Or any other questions? Yeah, the 200 period moving average is always still valid, but it's not this concept, right? So it's just something else, but it's, you know, I can't cover everything in our study session, so I take one concept at a time. All right. On the severe break, is that when you get out? Well, you shouldn't be in on a severe break, but you can be. No, that's not true. You can be, because sometimes you might take a buy in the zone and then the break happens. Well, you know, every buy, guys, remember, your buys all are always accompanied by a stop. So let's say, for instance, this is your buy. Let me open this up for you. So you see you're on the zone here. You're on the top of the zone, and here's green taking out red. So you're buying this bar right there, but your stop is under that bar. Like, you're not going to lose the event, right? So that this is your potential. Here's another buy, right? So this is your risk. This is your risk, and this is your reward. And this is your reward. So as long as your risks, it's the snowman effect, right? You want your risk to be much smaller than the snowman's body, the reward, on average. So if we go back here, I'm buying green above red. I'm not going to lose the low of the red. So that's my risk, and this is my reward. And as long as you're snowmanning, all right, as long as you're snowmanning, you're going to be in this game a long time, all right? As long as you're snowmanning, you're going to be in this game a long time. Okay. Let's take a quick look at something here. Here's something. Look at, here is MU, beautiful, beautiful opportunities here. Out of the zone, off the top of the zone, inside of the zone, off the top of the zone. Now, guys, if your buys come in the zone and off the top of the zone, your sells come in where? In relationship to the zone. You want to look to get out away from the zone, right? Away from the zone, away from the zone, away All right? It's not rocket science. Can we take this to here's a 5-minute chart of Micron, and here you have it in a smaller time frame, right? Okay, you're coming out of the zone, coming off the top of the zone, you're coming off the top of the zone, you're coming off the top of the zone, you're coming out of the zone. And so yes, you can use it on all different time frames. And the beautiful thing about this, guys, is that you don't have to predict when a zone, before a zone happens. Just if your stock has the zone working for it, you start playing off the zone whenever you notice it, you know. But use this, guys. Use this, and you can use this in all of your time frames, and use it in particular with the overall market and where we are right now, given the fact that a lot of things have cracked the bottom of their zones now. So monitor the next rally that the market has. All right. If that rally is weak, if that rally does not come all the way back, all right, to where things started to crack, we're in trouble over the next several months. And it's going to be months of trouble. It's not going to be days. It's going to be months of trouble. All right, traders. You know what to do. You are my babies, and it is now time to go to work. Thank you.